Hello and welcome to our first ever property update, market update. This is new for us. We've never done this before. It's going out the same day we record it. I'm Rob B with Rob D, and this is a little bit more raw. It hasn't got all the jingles, hasn't got all the fancy stuff, but it has got our opinions on what's happening now. And there's a lot happening now, and we're going to get into that and discuss it. But Rob, before we start, there's something we don't often talk about on the podcast, is our feelings. How are you feeling about everything at the moment?
Well, today is the last day that nurseries are open, so you might want to ask me again in a week's time how I'm feeling. It could be quite different. Yeah, I'm feeling all right. I think like anyone else, I'm worried about the health of family members and things like that. But more broadly than that, I'm aware that I'm in a very fortunate position. So I'm not going to have a lot of the short-term concerns that other people will have. So I'm kind of finding it really... Is it bad to say I'm finding it really interesting? Because it is really interesting times.
It is interesting. Once you detach the emotional side away, which I think we're allowed to do, I don't think it's going to benefit anybody if you spend the whole day crying every day and worrying about the future. So if you accept it for what it is, and then go, okay, those things are bad, and I accept that, and then park it. When you look at the rest of it, it is hugely interesting. It's interesting to follow the developments of what's happening with the disease and how it's spreading and what action's being taken and what action's working. But for us, I know it's massively interesting on how it's impacting the economy, the different steps governments are taking to mitigate the downsides to the virus in terms of its impact on the economy. And one of the things that people haven't really clocked onto and haven't really understood for me, speaking to friends, family, even some of the investors, is that the risk of the economic impact here is far greater than the health impact. And you could say, Rob, that's nonsense. People are going to die, and they are, and that is awful. I'm not belittling that. It's horrific. That's not nice. But the economic impact, if the right steps aren't taken, it could be disastrous. People could die from the economic impacts, which I know sounds pretty grim, and it's not a great way to kick off our conversation, but it is true.
Yeah, it is. There's a lot that we have to say on that subject. So there's things going on with the base rate in QE and various proposals that the government are putting in place to try to tide people over while this goes on. So I think we'll come on to all that, but we should probably start by talking about some of the property stuff that's gone on this week, because there's been a lot. And for once, we're not going to hate on government for announcing things without there being a lot of detail behind them, because the nature of the situation is they've had to reassure people as quickly as possible. So things have been announced, often just verbally, nothing really in writing. And so people have interpreted in different ways, and there's been lots of confusion. And things have changed as well. But the position that we're in now is that mortgage holidays are available for both owner-occupiers and for investors. Whether you're an individual or a limited company, you have the option of taking a mortgage holiday of up to 3 months from your lender. What you absolutely should not do is just stop paying your mortgage. You have to actually arrange this with your lender, and your lender will want this to be because your tenant is affected by the virus. So the tenant is unable to pay the full rent, therefore you are asking for a deferral on the mortgage. You shouldn't take the break if you don't have to. Technically you could, because they're allowing you to self-certify, they're not asking for any proof, but you should only take it if you need it. And the understanding is that that will allow you to reduce the rent for your tenant for that same period. So this isn't to give you a break, this is to give the tenant a break. And you will have to then make that up later. So it's not that the payments are being waived, they'll be added to the end of your mortgage term. So your mortgage term ends up being a bit longer. That means it'll end up costing you a bit more because of compound interest. The expectation is that you will do the same thing with your tenant. So you'll work out some kind of payment plan where they can pay back the rent that was reduced later on as well when they're able to. If you want to, you can of course proactively decide to just write off some of the rent, and if you want to do that, then that's totally fine too. So the key pieces of information are that mortgage holidays of up to 3 months are available from your lenders. You should only take them if you need to, and you need to be able to survive a period where you're going to have a loss of income, and you must arrange that with your lender and not just stop paying. The other news this month is that evictions are going to be banned effectively for a period of 3 months initially. So any evictions that are currently going through can continue. Presumably they'll continue much more slowly because of everything that's going on, but no new evictions will be allowed for any reason. Some landlords are upset about this because there's no provisions for evictions for like antisocial behaviour, things that have got nothing to do with non-payment of rent. But again, I think it's important that something got done quickly that reassured people, set their minds at rest. So given how quickly all this needed to be worked out and the lack of time to consult and think about the detail, I think they've actually come up with a pretty reasonable set of measures.
Yeah, I've been impressed by the government. Now, let's not get into who you support and why. I'm not interested in that. If we just become neutral, if we do our very best to become neutral for people listening, if you look at the measures that have been put in place, so whether how things have handled, park all that, but if you look at the measures that have been put in place with property and the stuff that Rob's just talked about, but also the stimulus packages that have quickly come about and changed and upped dramatically as well, it seems that the government is very, very keen to avoid that economic damage we talked about a few minutes ago. That economic damage could be horrific if the government hadn't taken these actions. But as a property investor, as somebody with a family to look after, and as somebody who runs a business and employs lots of people, you think, okay, you know what, the government is giving me reassurance here, and actually feel relatively positive. And that is really good news because that's what the government wants. They want business owners to feel good about how things are happening. So there are business-backed loans, there's billions upon billions of stimulus going into the economy, and that is all very positive. Now, we're recording this on Friday. You're listening to this hopefully on Friday. We're putting it out the same day. There's already noises that there's going to be more stimulus announced tonight by the Chancellor. Again, it just seems not to be slowing down. They're very on this. They're very keen to stimulate the economy, to back it as much as is needed to get us through this period. The window keeps being mentioned as 12 weeks. The amount of money and stimulus going in seems to be overkill for that period. I know some people may question those comments and go, what? There's no amount of money is too much. But it's massive. And you've all got all that stimulus as well. But then we've had the base rate cuts. And not just one, but two. So we went down from 0.75 to 0.25. And that was like, whoa. I got on the phone to you, Rob, afterwards. Oh, no, you called me that time. And we were like, wow, like, that's crazy. That's bonkers. And then yesterday, I called you minutes after it had happened. We went down from 0.25 to an historic low, a new record of 0.1%. And QE had started. So they're not messing about.
They're not. And I can't find offhand the number of billions that are being promised in QE, but it's a lot. It is a really serious liquidity injection. But explain this to me, Rob, because I understand a lot of the measures that are being taken, like anything that can be done to help businesses bridge this period where revenues have suddenly plummeted, helping to keep people in their jobs. And so when everything passes and activity goes back to normal, those people have still got jobs and everything can get going again far more quickly. That all makes total sense to me. Things like the base rate cut and QE, I don't quite understand because it seems to me, and I don't know a lot about economics, that's going to take quite a long time for that to filter through. So if we are looking at a period, and obviously no one knows how long it's going to go on for, but we're talking months rather than years, months where everything is at a temporary standstill. What's the logic of both of those measures, the base rate cut and QE? Because to me, I don't see how they're going to filter through in time.
I think you understanding how much you know about economics, first of all. But you're right. The general principle is that the money will be pumped into the QE money, the quantitative easing, for those who don't know what QE is. And quantitative easing is creation of money, and then they use that money to buy bonds. Now, those bonds will then help lower borrowing. And that's the key driver here. Because normally what QE will do, and this is the longer term effect that you talked about, Rob, is that you'll go in, buy those bonds, and then bonds prices will come down, so the returns seem unattractive, and then that will force institutional money into other areas and other assets, which will then help asset prices that way. That's the medium to longer term stuff. And you're right, that won't be instant, that won't be quick enough. But what it will do, and was aimed to do anyway, is bring down borrowing costs, because a month ago borrowing costs for the UK government were so low, and the budget that the government wanted to launch before coronavirus kicked in was taking advantage of that low borrowing, and that allows the government to then go and do all these grand infrastructure projects. But borrowing has been ticking up, understandably, over the last couple of weeks, and now it's more expensive to borrow money than it was a couple of weeks ago. But this is at a point when the government now wants to borrow more money than it's ever borrowed before to pump into the system. So, yes, it will boost asset prices, and this is where it gets really interesting what happens after this virus is dealt with. Yes, it boosts asset prices, but in the short term, it's hoped that it will then bring borrowing costs down as well. So we'll see if that works. The interest rate cuts, interesting as well, no pun intended. But it's the QE that really fascinates me. That's the one that I think is really interesting. And I've kind of hinted at it, and we'll talk about this more on the podcast next Thursday, like the longer term impacts of what's going to happen. But there's a lot of money being poured into this. Now, if you think of it as a fire, it's just fuel. And if the fire is allowed to burn, the money fire, and this virus goes away in 3-6 months, that money just doesn't disappear. It's like, oh, it stops. It's in the system. And once it's in the system, it's very hard to get it out the system. And what that will mean is an economic boom. Now, Rob and I have talked about the 18-year property cycle a lot. And we've said on the podcast that we don't think this boom will be as big as previous booms. And that's because the stimulus hasn't been there. But my word, the amount of money that's now going into our system could create the mother of all booms afterwards. And it's not to get people excited about it, because I don't think necessarily that's a good thing. You may think it is, because you think, yay, for a period of years we're going to do really well. But you can overdo it, and we know what happens when you overdo it. So it's a bit of a bonkers time, and we'll talk about that in more detail on Thursday. But Rob, I think before we sign off today, it's important that we talk about house prices, because we've seen a stock market crash. We have, and that's obvious. But some people are mistaking a stock market crash with a property market crash and thinking that either it's happened or it's happening. And so far, everything indicates to that it's not.
Yeah, I think there's a common misconception that a stock market crash means a house price crash, and it can do. And obviously, one precipitated the other in 2008, 2009. But there have been other periods where that's not been the case. So when the dot-com bubble burst, stocks crashed, house prices didn't. It depends on what the reason for the crash is. So in this scenario, the stock market in the UK is down by something like a third. And that's because there's a lot of uncertainty around. People are pulling money out into cash, because they don't know what's going to happen next. Companies' earnings for the next whatever amount of time clearly is going to be lower than expected. So there's a reason for the stock market to go down. What's the reason for house prices to go down? Well, that depends on how long this all goes on for. And it's the timing, to me, that's the really interesting thing about all this, because it's not unusual for the stock market to go down as much as it has over a period of months or a year, but it is unusual for it to happen in a week. So everything's happened really quickly. But if everything plays out as we hope it will, it'll also go away really quickly. So in 2008, we had this big event, and then it took years for it to work through. But that's because it was the whole financial system effectively falling apart. This time, the cause is completely different. This isn't some mystery. We know what's happened. We've got this virus. It's having very real knock-on effects in the real world. Basically, cash has stopped flowing. It's almost happened overnight. And that's a really scary, almost unprecedented thing. But then you know that when things get back to normal, people are able to go out and they're confident about their jobs and everything else, this all goes away. So if that happens in a matter of months, then I don't see where the impact on house prices is. Because as we've talked about, the government is going all out to keep things going and to protect jobs. So if you have effectively a few months of pause and then everything goes back to how it was, then there's no reason for house prices to be affected. If unemployment massively spikes and people can't pay their mortgages and you get repossessions, then everything changes. But at the moment, that to me is not looking likely. And it's also not looking likely to Savills, who this week stuck by their 5-year forecast. You'd think that something like this would happen and they'd just completely tear it up and throw it out and start again. But no, they've said, despite everything that's going on, they think over the next 5 years, year to year, the growth rates might be different, but we'll end up in 5 years in the same place. So they're not seeing this as a 2008 situation where you have the massive correction and then it takes years to come back again. Capital Economics this week said something very similar. So for me, Rob, it does all come down to the timing. You can't make any blanket statements because we don't know how long this is all going to take. But I think we have to work off the assumption that we're talking about months of disrupted activity, then everything gets lifted, everything goes back to normal. And in that scenario, I don't see why house prices should be affected. And in the meantime, of course, there are buying opportunities.
There are incredible buying opportunities. And I think next week, on Friday, we'll talk a bit more about the opportunities. The opportunities for property and the investments you can make there, but shares, stocks are down as well. And there's property stocks that we're looking at and going, wow, like they are cheap. Like, so we'll talk about that next Friday as well. We'll get into that, more about the opportunity.
Yeah, that's going to be a really important episode when we do talk about what opportunities exist. The nice thing is you never have to be a forced buyer, right? Like you have the option of whether to buy or not. So you can sit back and look at what the opportunities are and decide whether you want to get involved or not. But on the stock market side, you can be terrified about what's happening, or you can see the opportunities that emerge. You don't have to rush to get into those opportunities because on the stock market side, it's going to take a while for things to get back to normal. On the property side, again, you don't have to do anything, but there will be opportunities out there if you're minded to take advantage of them. So there are lots of different ways that you could react to what's going on right now. And I think when we have the chance to get into that next week, that's going to be a really fascinating conversation.
It is, and I'm looking forward to that because it'll be positive in a world that seems a little bit negative and scary at the moment. So we'll talk about the opportunities because they really do exist, and we can give you real life examples of what we've been seeing. So on Tuesday, we'll be back with Ask Rob and Rob, but of course, the focus of that is going to be obvious. We're going to be talking about current situations and answering your questions around the virus. Then on Thursday, we've got a real big picture podcast. So we're going to look at what's going to happen longer term from all of this. We're going to get into the economics of it. We're going to give you our views, our theories, and also take in stuff that we've read and we'll pass it on to you. It's going to be a really interesting podcast. And then we'll be back for another Friday market update, which I found the first one very enjoyable. Sorry if it's not as energetic as normal. It's just us two talking and giving you our viewpoints, but hopefully it's interesting and maybe even really useful and reassuring. You know, the world is a bit crazy, but there is a lot of sensible things you can be doing right now, and each week we're going to talk to you about them. So you can not only just get through this, but actually, hopefully, even prosper. But of course, the most important thing is your health and well-being and safety, and we wish you all the best. Stay safe, try and have some fun if you can, and we'll be back with you next week. Cheers, bye-bye.